Hey traders, Ben Watson here with you, and we are in the middle of earnings season. In fact, we're getting towards the tail end of earnings season. I just want to talk really quickly about an option strategy that some traders use when there is a difference in implied volatilities between one expiration and another, and that is a long put calendar spread. So let's jump into that here really quickly. A couple of quick reminders. Remember that everything we're talking about is simply for illustrative and educational purposes only. And if you're going to trade options, remember that options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that past performance of any security or strategy is not a guarantee of future results or success. So let's pop over here to the thinkorswim desktop software platform. We have here on the screen SBUX, symbol is SBUX. Again, not a recommendation, simply an illustrative example. And SBUX has passed their earnings announcement. In fact, they missed their earnings per share number, but their same-store sales was a little bit better than it has been. So we start to see the price of the stock falling and implied volatility going down a little bit, but it's still relatively elevated from where its lows have been. So what we're going to look at is the continuation of that price moving down into this previous area of support, maybe around the $78 mark. And now that's by no means a guarantee that the price is going to make that move to the downside. But with that short-term trend, this could be a fairly quick move to the downside into that support level. And if that support level does hold and price does move down towards that level, it's likely to see implied volatility stay where it is or maybe even rise a little bit if the price of the stock continues to fall. So we're going to use a calendar spread, and a calendar spread is simply selling an option in one expiration date and buying an option at the same strike in another expiration date. So I've got the option chain pulled up here on the trade tab. We're looking at the 14 November expiration and the 28 November expiration. And if we come over here to the left-hand side, we see that those are our dates. We've got 14 days to go until expiration, 28 days to go until expiration. If we go over to the right-hand side, we see that the implied volatility for our closer dated expiration, the one that expires in 14 days, is 33, almost 34%. And the implied volatility in the back month, or what would be the back month in this case, the expiration that is 28 days away on the 28th of November, is about 30%. So less implied volatility in the back month, more implied volatility in the front month. That decrease in implied volatility in the front month is going to work in our favor. A possible increase in implied volatility in the back month is going to work in our favor. So what we're going to do is we're going to put this together looking for where we think that stock is going to move. And again, no guarantees that it will do so. This is simply projecting an opinion based on technical analysis. So we're going to look at that 78 strike. That's where that level of support was on the chart. And we're first going to sell the 78 strike on the 14 November expiration. And then we're going to buy the 78 strike put option on the 28 November expiration. So same strike, we're just splitting expiration dates. And here's what that order looks like. Same strike, and it creates a calendar spread. Now, right now, our net debit in the trade is 62 cents. Times 100 shares, $62. If we go to the confirm and send button, and we extend that out, we can see that that is theoretically our maximum loss in the trade. But remember, this contains a short option. And there is the potential that that short leg, the November 14 expiration 78 strike put, could be assigned early. There is that possibility. Not a high likelihood, but it is a possibility that that scenario could take place, and we could end up in a situation where we have more loss than the potential theoretical maximum loss in the trade itself. So just be aware of that fact and keep that in mind as you're trading this type of strategy or any strategy that has a short leg associated with it. So what I want to do is I want to put this on the Analyze tab really quickly. We'll take a look at the risk profile graph and see what this looks like. So I'm going to click over here on the Analyze tab. I've already got this on the Analyze tab. Here's our trade. Short the 78 on the 14 November expiration, long the 78 strike on the 28 November expiration. Net debit in this particular case sitting right now about 63 cents. So if we move our cursor around, we kind of get a sense of where that max theoretical gain is. We can see that blue line, that is maximum gain at expiration. So that's the only time we know absolutely what this trade is going to be worth, because that's when all that extrinsic value is gone. That is at expiration on the 14th of November, the short strike. So in order to get maximum theoretical gain on the trade, a trader has to be, or the price of the stock has to be right at that short strike at expiration. So that's not a very probable scenario. So some traders will look at taking this trade off if it has made about 50% of what was paid for the trade. So if this trade could be sold for 62 cents plus another 31 cents, so selling this for about 93 cents would achieve that 50% of what is theoretical maximum gain in this trade. Now, this also allows for a roll because we have one more expiration in between these two. So if we were to look at getting close to expiration on the 14 November, that option could be rolled if conditions still exist and if there's liquidity to the 21 November expiration and continue the trade and maybe bring in a little bit more premium to offset the cost of buying that long leg and make it a little bit more profitable trade. And that's one of the reasons why when we click on that confirm and send button, we don't see a maximum profit, because there are two separate instruments here. And one of those instruments, in fact, both of these instruments could be rolled to keep the trade going over time. But this is a calendar spread, and it is a relatively, as we look at that Analyze tab once again, relatively low probability trade, meaning it has a low probability of getting to that maximum theoretical gain, but it has a little bit of directionality to it. It has sensitivity to the passage of time, and it has sensitivity to implied volatility. And if implied volatility goes down, that's going to benefit the front month. If implied volatility goes up, that's going to benefit the back month. So it can be a useful scenario or useful strategy given implied volatility changes post an earnings announcement. And that's why some traders may use this as kind of a utility option strategy around earnings season. So that is a calendar spread. Keep those types of spreads in mind as you are trading and look for those opportunities. And remember to keep a track of all of the educational webcasts and information that we provide out on schwab.com/coaching. And we'll look for you out there in our webcast. Thanks again.